Welcome to the Business of Property podcast. I'm Simon.
I'm Stuart.
We're both property people running our own businesses, and this podcast is just us chatting every week about the reality of anything and everything property. Before we dive into the conversation this week, please do open the show notes on your podcast player of choice and click through to our newsletter sign up. We will email out resources and charts and stats and tips and bits and bobs that we chat about in all of these episodes. You can also find that link on thebusinessofproperty.com, which is also where you can find all of our show notes as well for past episodes. Now, I think this week we are going to speak about return on investment, but not just applying to property, but applying to all sorts of investments. And unfortunately, in preparation for this, I had to work out my current return on investment for my cryptocurrency investments. And as it currently stands today, I am down 66% on my investment in crypto.
Oh.
So yes, I have to laugh or I would be crying. Thankfully, the actual raw pound numbers involved are fairly small. In fact, they're very small, really. So I don't need to cry too much. But the percentage, oh my goodness.
Can I just share an interesting, this is where maths gets interesting for me. You know, obviously we're wearing black as per usual when we talk about your crypto investment as is right and proper. But what's interesting for me in this is that when we talk about, and obviously, like you say, it's relative because the percentage is high, but you know, in real value terms, it's lower. So so it's not the end of the world, fortunately for you.
Yeah.
But
yeah.
When we talk about a 66% reduction, now if we just take that in my head for simple maths, right? So you think if I lose 66%, my head immediately thinks, well, I've got to make up 66%, but that's not true. Actually, your money has to work even harder because, in simple maths, if I had invested £100, we've gone from £100 to £34. It's not a case of you've now got to increase by 66%. You now need a 300% return to get back to where you were. And that is why I think we always have to be mindful of these things because, like we say, I mean, I think of it, thank goodness you didn't put in tens of thousands into that account because, you know, you'd have a significant hole in your hands. And you can see how some people get into trouble because none of us are out there finding 300%. But I guess that was the lure of crypto, Simon.
Yeah, although when I got into the crypto, it was on a nice upward climb. But it wasn't on crazy climbs, and I deliberately chose to go in on the type of crypto coins that I thought were more stable, more mature. In crypto, there are new crypto coins being created all the time, and if you happen to get in early, then you can make crazy increases. Of 300% would be the small end of that, because right at the beginning you've got all these coins, they're worth basically nothing. And then down the line, people have decided they're worth something. And that relative increase is huge.
And would you know they're still worth nothing?
Well, they are again now, yeah. But I deliberately chose not to go for that. I deliberately went for coins that I thought were mature. So I've got a little tiny bit in Bitcoin. I'm not so keen on Bitcoin, though, because it's the way it's created is very energy costly, and it doesn't really accomplish much. So most of my holdings are actually in a coin called Ethereum, and that's because it's when I bought it was energy hungry again in the way it was created, but they had plans, and they have now done this, to transition to a different way of creating the coins so that it's not nearly as energy hungry. And the Ethereum blockchain can be used for all sorts of things. So you can actually do useful stuff with it. It's not just a blockchain for the sake of being a crypto blockchain and running coins on it. You can have smart contracts and all sorts of other smart stuff that's built into the Ethereum blockchain. So I thought I would go for a coin that has some real use and is not going to be continuing to kill our planet forevermore. And hence I was hoping that my gains would not be in the sort of crazy 300% plus range, but they would be steady and reasonable. As it turns out, I got that wrong. And
well, I feel like the podcast itself, this podcast should owe you an apology, because I feel like you did it, obviously partly for yourself, but then also in the interests of research. So, you took one for the greater good.
Yes. Okay. Yes. I'll try to be happy about that.
Is that softening the blow at all? No.
Not a lot. No. But anyway, let's move on from my crypto disaster to something that's actually quite a reasonable success, I think, which is your timing of the shares investment market.
Yeah, that is to date quite positive. And like you, I'm still tentative because, I hate saying these things can go up and down, because I feel like a Financial Times advert, that history is no guarantee of future performance.
Yeah, although we can actually cover both the up and down, because you can talk about the up and I'll talk about the down in a minute. Yeah,
but so far that's the concern. But let's talk about the good news. So I took a bunch of shares back in February 2021, which I pay into every month now, and we've talked about this on previous podcasts, which we can reference at some point, I'm sure. But I keep a check on that, but I deliberately try not to check it that frequently, because I do see this as a long-term investment and a way of diversifying in property, because I am heavily invested in property. So I feel the risk. I feel very comfortable in that risk because I feel like property is good, but I do worry a little bit about being oversaturated in property. However, since I actually opened the stocks and shares accounts, so to date, from February 21 to today, we've generated just over 15%. It's generated a 15% return in that period. So in that, whatever that is, it's coming up to 2 years now. So it's probably not as good, but it shows that in that time period, it's up 14.96%. In the latest 12 months, not so hot, but it's 4.84%. And I just thought some people might be thinking, what stocks and shares? Well, I went for the FTSE 100. I do have some emerging markets in there, but I went for the FTSE 100 because back in February it just felt like there needed to be an uptrend for everyone in those. And we're talking about BP, Shell, AstraZeneca, companies like that. So they're the behemoths of the world, regardless of what your environmental persuasions are on that. So 4.84. Not huge, but it's, dare I say, better than crypto. And yes, I can hear some people saying, yes, but what about inflation? And yeah, okay, accept that's inflation. But, as I say to the other half, it's better than we would have got in any account so far. And of course, it can go down. But the real one for me was in the first 12 months. So from February 21 to just before February 2022, the increase was... the interest was 17.27%, just over 17%, which obviously I was really happy with. And of course, as you've said, I'm not talking about tens of thousands here. We're building the pot as we go. But when we think about our interest rates on other investments, and you've talked about this in a recent podcast as well, that you're getting a nice couple of percent, and I know some people that are getting that, and it's little effort. For the stocks and shares, yes, we've got the risk, but even on an average 4.84 I'm pretty happy.
Well, speaking of risk, so we were talking about stocks and shares, and we were talking about it off the podcast and on the podcast back around the time when you were getting that set up. And I thought, well, that's a really good idea. I know what I'll do. I'll wait 6 months until it's past the best buying time. In fact, you were already past the best buying time. But I was really past the best buying time. And then I'll buy lots of stocks and shares. And then I'll watch over a year, or now just over a year, while they lose 7.5% in value.
Ouch. Wow.
Well, compared to my crypto investments, they're doing really well.
Almost 10 times better. Sorry, worse. No, but yeah. Uh, well, this is the interesting thing, though, and I think and I'm sure we've all read key information around investment, and I'm putting crypto to one side because I think that stands alone. But in what we call standard investment, stocks and shares or property, I think the value is always going to be in the long term. So although it doesn't please me to hear that you've had a negative interest rate for a 12-month period, I'm fairly certain, depending on what you've got, unless you've picked your own specific categories that were outliers.
I've gone in for a couple of tracker funds. One of them is the Vanguard. I can't remember what they call it, Life Strategy or something or other. So yeah, and the other one's in ESG. Again, a tracker fund.
Environment, sustainability, governance.
Yeah, something like that.
Stuff.
Good things.
Yeah.
So yeah, and so I've just kept it simple, and gone for those. But yes, obviously I timed it very badly.
But over the course of 5 years, I'd be surprised if that holds true. And and again, 10 years, and that was me. So even if mine leveled out, for the first year, 17%, I actually got worried because I was thinking, oh crap, does this mean something else is going to happen? So, I mean, human nature means we're never happy. So when it averages out at 4.84, I'm a little bit more comfortable with that because I guess that's the numbers I feel are probably more sensible. And something that we were thinking about before we hit the record button is on a couple of podcasts ago, we talked about property price increases because that's all we've been talking about for a couple of years. But one of the stats that just stayed with me from that podcast was that on average, UK property prices in the last 3 years increased by 25%. That was quite a staggering number to me. And then, of course, if I think about that on an annualized basis, and once again, it's average, but it's roughly 8%. So if you bought a property just over 3 years ago, on average, that property value has increased by about 8%. Obviously, that then leads us into another conversation, which is, well, but it's not as liquid as, say, stocks and shares, and it's not realised gain until you've realised it. You've sold the asset or leveraged it somehow. But it brings us back to the power of property because that's just the capital growth, in terms of yield. And I guess that, Simon, brings us kind of back to property, which is stocks and shares. I think if we think about how that stacks up against our property investments, I mean, obviously from your situation, I think we're fairly confident we know where your better investments were made.
Yeah, it's not hard to spot the bad ones, that's for sure. So, I mean, on the property side of things, I have thankfully done a little better. So I haven't worked this out across my whole portfolio, but on not my most recent purchase, because that was very recent, but the one prior to that, which was now about 5 years ago, I have worked out my capital gains on that one. And the value in that property, the value of that property has gone up by approximately 50%.
Wow.
In 5 years. And this is, of course, on top of rental income and my current return on equity. And so they not including sort of the extras you put in when you purchase a property, sort of stamp duty and things, but the value that's still there. My return on equity is currently running at about 3.7%. So that's sort of the cash flow returns of my portfolio. But yeah, it's just looking at my capital gains. My portfolio is mostly in the southeast. In fact, it's all in the southeast actually, and obviously that area has gained well in the last few years. And this particular property that I picked out, just because it was my most recent purchase, yeah, about 50% gain in the last 5 years. So yeah, I clearly need to stop dabbling in things that I don't understand and focus on things I do a bit more.
Well, you're learning. Yeah, at least you can take it that you've been able to share it for the greater good, and that we hopefully won't make those same mistakes that you made.
Quite. Although I think certainly in terms of looking at the crypto and the shares, as it currently stands, the timing has mattered so much. And those investments are less than 2 years old. And I'm comparing them to a property investment that is 5 years old and a property portfolio that's a lot older than that. So I think really it could just be down to time. And 2 years is just too short a time, especially with the recent turmoil in certain places. So I think it can really come down to the amount of time I've been invested in these things. At least I certainly hope so. I'm still hopeful. Actually, I may have written off the crypto, but I'm still hopeful that the stocks and shares will make a comeback. And in 5 years' time, I'll be able to say that they have performed a lot better.
Well, I'm confident, as I said before. I'm confident that the stocks and shares will do. If they're based on the top, 100, 250, which those things are. I think that that's likely to happen. Otherwise, it means that those businesses no longer exist. And just while we were talking about that, I thought I'd just strip out a very old property and just looking at what's in my company's portfolio or total overall. I've stripped out a property that we've owned for a long time and put in all the recent ones, with the oldest being maybe 5 or 6 years ago. But in terms of total portfolio, so based on current valuations and what we bought it for, the total portfolio has increased in value by 33%. So again, we're just looking at capital growth alone, roughly 6-ish%. So, or very close to, what I've seen in the stocks and shares on average for the last year. And obviously that's not the yield, that's just property valuation. And that kind of, I guess, does allude to the point that it is aligned with inflation, so that if you have property, it is something that works with inflation because the property values will go up. But obviously, we're in exceptional times right now, and because of the significant increases we've seen, in the last 2 or 3 years, that I guess inflation will continue, but the property values, as we've already talked about on last week's episode, will be dropping.
Yes, and that is, inflation is, of course, the big counter to all of the things that we've been talking about so far today. Although I say counter, actually it's just making losses even worse, isn't it? But the counter to the gains. I don't know. I mean, we've only had the really high inflation for the last year or so, so it's going to counter some of those gains, but not some of the more historic ones. Certainly with the sort of properties that we've got that are 5 years old, it's only going to be countering some of the more recent gains on those. Going forwards, we can obviously know that inflation is going to stay high probably for a year or so, and our investments going forwards, we need to be looking for something that's going to at least match, if not beat, inflation in order to sort of stand still. Although then we've got leverage as well, which is devaluing our debt, so the calculations become a lot more complicated.
And I know this sounds simplistic to say, again, because that's me, but when I think some people think about inflation, I think there's a tendency to feel like those prices are going to drop. But inflation is just a comparison against a price that once was. It's not. They're not. Those prices don't necessarily and won't necessarily drop again. This is in effect the new pricing structure that we're in. And the reason I'm saying that is because certainly in my business, we're not planning for utility costs, for example. We're not planning for those to drop again, and of course we can't because of what we know. We know that that's going up, and obviously I'm not just talking about energy costs. I'm thinking about the costs of a loaf of bread or butter. Is that actually where we're at now? That they are the new costs, and it's unlikely. I'm not saying impossible, of course. In certain product categories in certain sectors, that prices may go down, and of course we're not economists, so that this is about as deep as I will get onto this subject. But the point being is that, yes, inflation's happened, but this is now the new cost base. And certainly so within my property business, we've had to, last year, take a huge hit on our cost base. And as you and I were talking before, and we've shared on this podcast, the utility costs alone went up by 50% in the business. And that was huge. Now, because of the tenant profile, because of the contracts, we did not put the rents up, and we stomached those. And I was happy, in inverted commas, to do that because I, number one, needed to work things out, and I didn't want to just turn around and just start putting the costs up willy-nilly, the rents up willy-nilly to tenants without having worked things through. And I know we're evil landlords, but for me, I felt like, we've taken 6 months to really just work this through and work out what we do. We've now worked through, we feel like we've stemmed the loss on utilities, as in we've stopped them rising. We've fixed that for the short term anyway, until the next barrage of increases comes in. And we've done what we can. However, the next step is for us is we do need to increase the rents in line with, overall inflation. And it's not just us, it's everyone in this market. And that was the challenge for us, which we'll talk about in another podcast, which was we had to really assess the local market because everyone was priced similarly. But now, having spoken with other agents and other people in the market, it feels like we're all going to make those increases because we had nowhere left to go if we still wanted to run those properties. And I appreciate I've just kind of run off now, aside from it. The impact is really, of course, on the yield. So we're talking about the rates and the yields that we've had. Well, of course, the yield that we had on our properties for the last 12 months dropped significantly because of all of those things. And I was just really highlighting that because it's easy to talk about the fact that our property portfolio increased by 33%, but there's nothing tangible that's come from that because the ongoing costs and revenue stayed the same and the costs went up, and we know how that works.
Yeah, I know we all need to look at putting rents up, and I know I think we should talk about this more in another episode because we're pretty much out of time for today. But inflation is running at 10% or a bit more, and that means that, rightly speaking, to sort of stand still, we should be looking at increasing rents by 10%. But that just sounds like such a big number to me. And you were saying in certain situations you need to increase it more than that because inflation, the average inflation, might be at 10%, but utility cost inflation is much higher than that. And because you've got that built in, you've got to allow for that in your increases. And that means you're looking at much, much bigger percentage increases. And they just sound so scary to me. But anyway, I think we should leave it there. I think we should dig into that on a future episode.
Well, the final point I'll make is that, it's like a 66% loss. That sounds really high.
That's because it is. Well, I hope you've enjoyed listening to my misery in recanting investments of recent times, but also found it interesting to look at the comparisons between the different investments and indeed the different timings of our investments. And if you have, please do open your podcast player and leave us a rating. And maybe even a review, but just a rating would be fantastic. We really would appreciate it. It will help other people find and discover this podcast and enjoy our rantings as well. You can find show notes and all our past episodes on thebusinessofproperty.com, which is also where you can sign up for our email newsletter. And Stuart and I will talk to you again next week.